In this session today, we're going to look at equity risk premiums, and we're going to discuss whether the current elevated levels of the equity risk premium suggest that equity markets are an attractive asset class. We're going to look at both the US and the Australian market. So I'm going to first turn the attention to the US, and using the IBIS consensus earnings data, we calculate an implied discount rate. So just a couple of observations to make on this particular series. You can see how it's dropped from around about 11% in the late 1980s to around about 8% average, probably ever since about 1999, 2000, with the brief move up towards 10% during the GFC and the decline down to about 7.5% in 2014-15. So, but basically on average around about 8% over the past 15 years. What's happened to bond yields over the same period? Well, we all know that story, so I'm just going to bring that in here on the right-hand side. And bond yields obviously have continued to decline throughout the whole period, in particular since the GFC, from around about 4.5% to below 2% today. So when calculating an equity risk premium, as we'll add that to the chart here, that's the gold line now. So you can see pretty much up to about, say, 2007, we might think of an average on this calculation of the equity risk premium being around about 4%, maybe a touch under, but very much since the GFC, it's moved up to a higher range, probably averaging around about 6% or a little bit under. In fact, the trough in the equity risk premium occurred around about 2000, as we can see here, around about 2%. So since that period, as we mentioned earlier on, the discount rate, implied discount rate, has remained about 8%, yet bonds over that same period have fallen from 6 to below 2%. So does this elevated equity risk premium suggest that there's good value in the equity market? So we investigate some of the assumptions here, and as I mentioned, we're using the IBIS consensus earnings numbers, both in the near term financial years, also medium term EPS, and also the long term EPS is a number derived from the relationship of earnings to GDP. And in this particular calculation, it's using long-term EPS or trend EPS in the US of around about 5%, which is around about the lowest level since the 1960s. So what if we change some of these assumptions? We can also consider perhaps bond yields. Perhaps the market is suggesting that bond yields should return back to their something like more normal levels. That might be one reason why the equity risk premium is not as attractive as what it seems on this chart. Or as I said, it might be that the long-term EPS assumptions are overstated. So I'm going to investigate those two factors, and then we'll look at some other potential temporary factors. So let's look at the bond assumption first and say, okay, let's take US bond yields back to normal levels. And by normal, in this instance, I'm going to say back to around about 3.5%, which is roughly in line with the nominal GDP of today. So not long-term average by any stretch, but certainly a level that's higher than here. So you can see there the green line now is our normal US 10-year bond yield assumption rather than the current sub 2% levels. What does this do to the equity risk premium? So using that measure, now the purple line has become the new equity risk premium using a normal bond yield. As I said, we're using post-GFC as the post-GFC period is the cutoff point for using the normal bond yield. So what it does is it brings this purple line, the equity risk premium, back from what seems to be a very attractive level back to probably somewhere around about the average. So perhaps the market is implicitly saying, look, we don't believe bond yields at these current low levels. We're going to work off the assumption that bond yields return to normal, and therefore equities are probably around about neutral, maybe still slightly attractive. Another approach might be to say that the EPS, the long-term EPS assumption is too optimistic. So let's just use, I'm going to use, rather than the 5% long-term EPS assumption that is currently used, I'm going to use one that's 1% lower since the GFC. So we're going to say the long-term trend EPS numbers have actually declined. So let's bring that into the into the calculation. And that new measure is the light purple line, as you can see here. So from the original, with using original bond yields and original long-term trend EPS, we now reduce that by about 1%, and it has that provides that light purple line, which still has the market perhaps modestly attractive, but certainly not as attractive. So there's two possibilities here, that the market is factoring in a return to more normal bond yields, in which case the market is about neutral, or perhaps keep bond yields are correct and that the market needs to adjust down its long-term trend EPS numbers, would leave the market still maybe slightly attractive, but not as much as it might appear on the surface. Of course, there may be other factors that are causing perhaps a more temporary move up in the equity risk premium. And one of those, or one ways of perhaps measuring that is a measure that is quite useful. It looks at policy uncertainty, which is a function of not only mentions of words recession and uncertainty in the media or in the press, but also divergence of economic forecasts and potential changes to policy and tax. So that particular measure, you can see here, and the red line has moved broadly in line with the movements in the equity risk premium. You can see it's particularly noticeable in the early 2000s, and of course during the GFC and post-GFC, probably European debt crisis in here, and more recently it's also spiked up. So there has been some sort of relationship. So you could say that notwithstanding the assumptions about bond yields, the correct level of bond yields and the correct level of long-term EPS, perhaps near-term, short-term movements in policy uncertainty are also a driving factor, and the markets are being correctly priced for that. Now we'll have a look at the Australian market, and once again, now I'm looking at the implied discount rate for Australia. Shows a very similar pattern to that of the US, although somewhat a higher level, where it came down from the sort of mid to high teens in the late 80s down to around about 10%, and it's pretty much averaged, say, 10% ever since 1998, with once again the move up to sort of 12 to 13%, and more recently coming towards the lower end around about 9.5%. Now, if we add in, as we did earlier on, the bond yield for Australia, adding that to the right-hand side, and once again, certainly our market has been in a fairly significant downtrend over that time period, particularly since the GFC, where bond yields were up around about 6% prior and subsequently falling to just below 2% more recently. So what does the equity risk premium look like for Australia? And that is coming up now. So I suppose in somewhat similar to the US measure, this is the gold line now. We can see that since the GFC period, it has moved to a higher level, having been around about that sort of 3 to 4% during most of the previous period. It's moved to a slightly higher level. So the implied discount rate's been very steady, while at the same time bond yields have moved to quite significantly lower levels. Now, once again, now let's have a look, investigate some of the assumptions there. What if we used more normal bond yields in the analysis? And in the case of Australia, I'm saying normal bond yields might be 4.5%, arguably. Let's say that represents sort of something like nominal GDP growth, which more recently has been closer to 2%. If we return it to around about 4.5%, so bond yields could move 2.5% higher than where they are. What does that mean? What does the equity risk premium look like in that sort of situation? As you can see here, that's the purple line now. The original line is the gold. The new equity risk premium adjusted for more normal bond yields has the market, probably still slightly attractive, but not far off, not far above the long-term average. Very similar picture to that we saw for the US. And then what if we use a lower long-term trend EPS? For Australia, the numbers we're using is 6%. Once again, is already low by historical standards, but if we drop that a further percent in the post-GFC environment, reflecting lower long-term trend growth, nominal GDP growth, and trend earnings growth, what do we get? Now, it's now the light purple line. So we're assuming bond yields are actually correct. but that the market needs to adjust down its long-term trend EPS numbers. So it has the market maybe slightly attractive on that basis if indeed bond markets are correct. So it's interesting to see the impact of those assumptions. And I'll just finish off with just a couple of comments on policy uncertainty. Uh, there is also a series policy uncertainty for the Australian economy, and I'm looking at here alongside the base case or the headline equity risk premium using the unchanged assumptions. As you can see there, that's also spiked up around the election time, and it's generally followed those movements in policy uncertainty over that period. Of course, one of the other drivers for Australia is not just domestic policy uncertainty, and it's going to be related to the China policy uncertainty. So now I'm using the Chinese economic policy uncertainty measure, and that is still elevated as we are constantly reminded that China's in transition. So there may be both some structural sort of factors behind the apparent elevated equity risk premium, and there could also be some temporary real uncertainty factors driving it. Thank you.